Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing if stock market investors are walking into a trap. In this session, we will be looking at the US stock market, which has rocketed to historical highs, even though the United States economy is in the grip of the coronavirus. On Friday the 4th of December, just post the non-farm payroll numbers and the S&P 500 index reached all-time high records. This was also the case for the Dow Jones 30 Industrial Average. The Nasdaq Composite Index followed suit. So did the Barron's 400 Index. For all of these indices to simultaneously hit fresh all-time record highs, it's a very rare occurrence. It shows that investor sentiment is extremely high, potentially buoyed by a forthcoming and greatly anticipated next round for the COVID stimulus bill, if and when the Democrats and Republicans can reach an agreement on the size, which is currently estimated at $900 billion. The markets are also confident that the Federal Reserve is doing a good job in propping up the ailing American economy and sticking to a policy of low interest rates for at least the next 2 years. This has corresponded with a higher investment in stocks and shares, historically speaking. Investors will look at the Fed's response to the crisis as a kind of insurance policy that is behind the scenes of the Federal Reserve will not allow the stock market to crash. However, analysts who follow the Buffett Indicator, which is the original measure of the US market capitalization, point out that since 1947, earnings per share have grown around 6.21% annually. The economy has expanded by 6.47% annually. This premise that the market capitalization ratio to gross domestic product is based on the economy driven roughly 70% by consumption. This is where individuals must earn in order to buy products. That consumption is where corporations earn their revenues, and ultimately this is where the profits come from. The Buffett Indicator shows that the mean average of around 0.7 has been closely adhered to since the 1950s, and the last time it broke away to the upside, which was in 1999, speculators were investing heavily in dot-com companies. This led to the market crash in March 2000, where we see that around this time the indicator pulls back to the mean average. Analysts at Deutsche Bank also point out that the recent run in US stocks has taken the market shift above the ratio price to earnings to above the level seen just before the 1929 stock market crash. Here we see that current levels on the indicator are again highly inflated to record highs on the graph above the mean average around 1.7. And this coincides with being above 2 standard deviations of the average range, which is an extremely rare occurrence. With the American economy still suffering from the pandemic, American corporations' profit ratios are not reflective of consumer consumption. Rather, this time we have a Federal Reserve and US government stimulation packages which are churning out dollars into the market. Investors are using much of those funds to push up the level of stocks due to FOMO, or fear of missing out, and where the traditional corporate valuation matrix simply do not apply to certain stocks anymore. Fear of a recurrence of the dot-com bubble correction, where investors ignored earnings per share valuations, many of these dot-com firms were not making any profit at all. This is another reason why we might potentially be looking at the top for stocks. Also, many of the favorites for investors such as Amazon, Apple, and Tesla, for example, are not cheap anymore. This means that investors will be looking at cheaper stocks with potential for growth, while others which are too expensive are then seen as potentially overbought. In an economy which may not see growth return to any kind of normality for years, adds weight to the thorny issue that the Dow Jones 30 Industrial Average, home to the top 30 most expensive stocks in the USA, and which is considered as a benchmark of health of the US economy, may find buyers to be in the ground now, in which case a correction could be not too far away based on everything set out in our assessment today. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.